All right, today we're going to talk a little bit about Daniel and Raz's myth busting a little bit, right?
Yes.
So, what are some myths out there?
So there's a lot of different investment ideas and investment strategies out there, and we're not really for or against any of them. They're all good for certain purposes. There's tools that you can use for certain things. And the problem is, many people do not consider the tax status of the money that they're using for that investment. And each investment has its proper tax status, which is going to be more efficient than everything else.
Yeah. So, for example, Daniel, I hear on the radio all the time and TV, hey, change your IRA to a self-directed IRA and then invest in real estate. Then you can invest in real estate inside your IRA. That sounds like a great idea.
Well, as a tax attorney, I say that's a terrible idea in most cases. It's not usually a good plan to have real estate inside your IRA. Why? Well, there are several downsides. First of all, you have very high management and admin costs, and sometimes there are appraisals you have to do very often, maybe even a couple times every year. And then what happens if you have a rental property in your IRA and you need a new roof on the place? A new roof's going to cost $30,000. Well, you can't put money into the IRA. Most you can put in 7,000 or so. So now you're out of luck. So it's very difficult. Now, what do you do if maybe you want a loan on the property? You can't really get a residential 30-year fixed mortgage at a great rate inside your IRA. There are commercial loans that you can get, but it's very difficult. It's much less favorable terms. And then finally, the most important tax benefit of owning real estate is those depreciation you get every year, and then you can leave it to your kids, and the kids inherit with no taxes at all. All of that's gone inside of an IRA. And there's actually another one that I don't usually add to this list, but we came across it recently with two different clients that had properties in their in the IRA, and they want to get it out. They're like, I want to keep this property. I don't want to sell the property. I want to keep the property, but I want to get it out. Well, there is no way to get it out to yourself. It's a prohibited transaction. The IRS will not let you transfer that property to yourself, even if you pay full value for it, because it violates the rules. So the only way to really do it is to liquidate the IRA entirely and pay tax on the whole thing at once. And it's not a good situation. So it's hard to get out of.
So basically, you're tying up your hands in a lot of ways.
Exactly.
You're deferring taxes, but that just means you're going to pay taxes later, as opposed to having all the tax deductions now and having more tax-free income.
Exactly. And of course, we like real estate. Real estate is great in certain situations for many people. The problem is it's not a good idea to have it in the IRA. So have it in the outside of your IRA. So,
and the other thing I've heard is, these fixed index annuities. People are saying, especially in retirement age, you want to guarantee your money, protect your money, put it in an index annuity or put it in an annuity. So what if I just liquidate my Apple or Microsoft stock and use that money to put into an annuity? Would that be good for me?
in many cases, no, it would be a bad idea. And the reason is you're liquidating some stock that you did not have to sell, but you're selling it now and you're paying capital gains. Then you put it into the annuity, and the annuity grows, and the income you take out is taxed at income tax rates. So you paid capital gains, which you didn't have to, and then you created income tax, which is worse for the future. So that's a problem. Now, if you had a choice between selling the stocks or maybe using some IRA money for the annuity, IRAs are much better for annuities. When you roll over an IRA into an annuity, it maintains its tax status, so there's no tax on the transfer. It stays an IRA. Then the income coming out is taxable, but it already was taxable in the IRA, so there's no new tax that you're creating by doing that. So if you have a choice of IRA and cash or stock money to buy an annuity and you're thinking of buying an annuity, it's usually better to use the IRA. Now, you can also convert that annuity to Roth, and then it's tax-free income. And so we often see clients get things backwards. They have a great investment idea that may be perfect investment for them in their situation, but they're using the wrong tax status for that. So make sure you have a tax attorney that analyzes which is the best status for your accounts so that you have the most efficiency you can get out of your investments.
So what I'm hearing is you're not really against annuities per se. It's just more of how is it
Right.
taxed. But in some cases, like for example, we had a client not too long ago. They wanted to defer the income because they had a whole bunch of money in treasuries, and that $50,000 of income that was coming in every year was putting him in a higher tax bracket that he didn't want.
Right.
So in that situation, moving that to a fixed annuity deferred the income to later.
Exactly. And so, but in his case, he's not paying any capital gains because it's all treasuries. There's no gains on those. So if you have highly appreciated stocks or something that you're selling, that may not be a great idea to put into an annuity, but cash sometimes can be. My favorite is usually the IRAs because there's no change in the tax status.
So bottom line is you should talk to us. We work as a fiduciary, so if we talk to you, everything we talk about with you will be in your best interest. This video is only for general information purposes, like classroom. But if you make an appointment, we will make everything specific to you.
So click the link in the description and we'll be happy to talk to you.